When a friend asked me recently to choose between TikTok IPO and Robinhood IPO, more so because they will soon go public, and then asked me again to tell him why I would choose one over the other. Well, in my response, I told him I will have to examine both companies' historical data and look for some key basic metrics before I would make any investment decision. Thereafter, I let him realize that I may not invest in any of the two IPOs. Well, do you want to know why? Stay with me. Welcome to my channel. Time to subscribe. Meanwhile, before I soldier on, I think you would like to know what is IPO and reasons for a company to initiate an IPO, go public, if you like. Well, IPO stands for Initial Public Offerings, and it refers to the process of offering shares of a private corporation to the public. I mean, when the stock of a company gets listed on the stock exchange for the very first time. Okay, the next question should be, why would a private company go public? Or what is the benefit of an IPO? Stay with me, let me break it down. You see, an IPO is a big step for a company as it provides the company with access to raising a lot of money. This gives the company a greater ability to grow and expand. And the company paperwork, financial status like income statement, balance sheet, etc. becomes available to the public. In effect, the company details become transparent, and this strategy increases transparency and then project the company as a very reliable company, which is another key element in helping the company to obtain funds from banks and financial institutions. Okay, wait. An IPO could also mean the current owner wants to cash out when the price of the stock price is up. It could be an exit strategy for the company founders and early investors after realizing the full profit from their investment. That said, so the answer to my friend, to answer my friend from an intelligent investor perspective, I have decided to ask some fundamental questions. 1. What is the reason why this particular company, this time, remember the word this time, decided to offer their shares for you to buy? Well, the answer is, 97% most of the time is to raise money. Like I said, it could be that they want to raise money to expand, for more growth, which is absolutely a brilliant idea. Well, again, many companies decided to go IPO because of the tons of debt. You see, the first thing is to gather as much information about the company and find out how they intend to use the money raised. Again, check if the company IPO prospectus stated what they will use the money raised for. Is it for expansion, growth, or create new products? And then create new software for their cars, for instance, so that they can remain competitive. If this is the case, then it is a green light. Then you should be aware of the term vendor shares. Meanwhile, I must admit, I do not know about this concept until when I heard it from my mentor, then I researched it. So I will break it down in simple terms for better understanding. Stay with me. A vendor is a general term used to describe any supplier of goods or services. A vendor sells product or service to another company or individual. Okay, here's the key. As the company go IPO, they are not just selling new shares, they are selling what is known as vendor shares. What does it mean? Simple. It means you are buying the shares from the founders of the company. I mean the stakeholders, like the CEO, chairman, private investors, and the employees. Meaning your money is not going directly into the company, but into the pocket of these stakeholders, the founders. Now relate the stakeholders to the vendors mentioned earlier. You remember from our definition of vendor, vendors sell products or service to individual or company. However, this is what you should be aware as you buy the vendor shares at IPO. You are buying it at the most expensive price. Let me emphasize that. At the most expensive price. So the question you want to ask is, how will you avoid this trap? All you need to do is read the IPO prospectus to find out the percentage of new shares and vendor shares. Again, you see, we have what is called offer price, which is the price at which the bank should sell the stock to you based on the valuation of the stock. But alas, not everybody will have the privilege to buy it at this price. Again, let's say the offer price is at £25. However, the open price could be at £48. You see, these few privileges, like the high net worth investors and the institutional investor who buy the shares at offer price, now sell their shares at £48 to you, making some gains as soon as the market opens on the first day. I hope you are getting the picture of why IPO is a risky business. I mean, a bad investment strategy. Okay, let us use Uber as our case studies and relate what's going on. You see, based on the historical data, after the first day or few days, most of the price on IPO will nosedive to very a significant support level, if you like. I think you want to ask me why this sudden drop in price. Now let us look at Uber. This is when it was IPO, I think around May 2019 thereabout. Now have a look at what happened shortly afterwards. It drops. We have the 50 moving average above the 20 moving average. This is a significant drop. Okay, I think you want to ask me why this sudden drop. Okay, let me break it down. There is what is known as the IPO lockup period, when the insiders agree not to sell the shares of the company for a certain period of time. And once this period is passed, many of them will sell their shares, which eventually drive the price of the stock down, as I've seen here. Okay, back to the second question my friend asked me. Reason why I would choose TikTok over Robinhood and vice versa. Well, I like to emphasize this key point. When you buy the shares of a stock, you are directly buying a business. What do I mean? You should be able to get a good understanding of the business embedded in the stock or behind the stock, if you like. In effect, if it is a good business, I mean, if the business appreciates, the stock will also multiply in value. Why? With a lousy business, you will lose your hard-earned money. Meanwhile, to determine whether a company is reliable and profitable, the first thing to examine is the company fundamentals. Again, let me borrow the method of my mentor, which I consider a very reliable strategy, having studied it over the years. Okay, what you want to look at is you want to check the company record and see if you can see consistent growth, sales and revenue, with cash flow from operations, net income consistent over the years. Okay, this is the real moment of truth Time to evaluate TikTok and Robinhood. You see, these two companies do not have over 3 years track record. These companies don't have a record of consistent growth. Net income, cash flow. Again, this is very peculiar with most IPO. Please note there are a few exceptions though. However, for most of them, they are still at the fledgling stage. Hence, they are not making money as at yet. And because both companies do not have historical data, like PE ratio, projected cash flow, discounted cash flow from valuation, etc., it is impossible to calculate this company intrinsic value. So you will not be able to value the business. Okay, let me look at both companies through the lens of a moat. Which one has the sustainable competitive advantage out of the two? Well, in my opinion, Robinhood has no strong economic moat because of so many competitors. The lack of Charles Schwab's, Ameritrade, Trading 212, eToro, Interactive Brokers, Vanguard, etc. And TikTok, one could argue that they have a narrow moat. A narrow moat. Though it is similar to YouTube, yet very different. Again, TikTok is owned by ByteDance, which was founded in 2012. ByteDance is a technology company that specializes in the use of artificial intelligence to link people with large amounts of information. You get the picture. TikTok will benefit from ByteDance artificial intelligence as leverage to remain competitive in the market. Okay. In summary, if a company has no track records of sales, revenue, no net income, in effect, no way to calculate the intrinsic value to determine the valuation of the company. As an investor, I'll be very careful not to be carried away by the hype concerning the IPO. The media frenzy. Well, to answer my friend question, because he think I should at least pick one out of the two. Well, I could buy into TikTok IPO because of ByteDance, financial and management backing. Well, please note, I will only buy the IPO if I could get the offer price. Please underline the word offer price. Now, good news. Check my video titled How to Invest £100 and Pick Valuable Stocks. Again, more good news. If you're in Africa or Asia and you want to invest in Europe in shares, US shares and China shares, well, there's a way to go about it now. You can open an account with Ameritrade and Charles Schwab's international account for Africans and Asians. There's a video I produced. You will see it at the end of this clip. Okay, here comes the best part. Subscribe, like,